Hey everybody, I brought back Ian to have another great discussion on these markets. I'll always love talking to Ian so we can chat about macro commodities. He studies the global markets just as I do, and it's always fun to have these conversations with Ian. How are you doing today, man?
Excellent, man. Thanks for having me.
Of course, dude. It's always a blast to have you on here. The markets have been, we had our last talk and we were kind of talking about all these things that were kind of happening and what we were seeing at the moment. And really, like, last year we talked in October, we talked about the possible of the October bottom that's still playing out, that's we haven't come back and hit that yet. That's an amazing thing because everybody is still very bearish. And like the best phrase I ever heard when I started trading was bull markets climb a wall of worry. And when everybody's bullish, that's when I don't want to be bullish, but I'm still happy to be bullish right now because there's so many bears out there. And I think what we get into so much as traders is we see these people who are they're big thinkers, they're really smart, and instead of kind of like, for me, I always talk about it like I try to be a caveman in the sense where I go, market up, I'm bullish, market
Yeah.
down, I'm bearish, like
Yeah.
there's no more thought than that for me most of the time. Yeah, I see that there's these things in the news and that there's a possible recession and the Fed and all this stuff, but you can't argue with price. So
Absolutely.
what are you seeing out there right now?
You know, it's interesting. I think that there's a number of things that really stand out to me. One is just the strength from growth. The bearish to bullish reversals in price and XLC in the communication sector. The strength in tech. Um, we've spoken before, over the phone, months ago, and we were talking about how, tech tends to lead news cycles, and I really think that's where we are right now.
Yeah.
And like you're just saying, like everybody's focusing on the next crisis. Now it's the debt limit, right? That's a
Yeah,
crisis. Like,
the
like
debt
I
ceiling.
mean, come on, the U.S. isn't gonna default, so it's crazy. And then if it's not that, then it's what's Powell gonna say? What's the Fed gonna do?
Always the debt ceiling, or the Fed, or some magical thing that they're always talking about.
Right. Where you look at the charts, and I mean they're constructive, to say the least.
Yes. I mean, you look at growth here, the outperformance. I was just pulling up a chart of this because I was thinking about this as well, is the outperformance against the S&P 500, that's 8.6%. That's a big outperformance considering they're both in an uptrend.
Hmm.
Quality. And if you look at everything else is down, in comparison. So it's like you have these um, style factors that are really like saying like, hey, we're in a thin rally, but it's a rally, and I know so many people like the big thing in technical analysis for the last like 6 months had been breadth charts. Have you
Yeah.
seen the breadth charts? Like, and it's like, yeah, like, but also I know historically from being in the markets for a little while that there is plenty of periods where it rotates back and forth. Like coming out of that October bottom, breadth was great. Everything was moving up, and then coming out of the February bottom, breadth looked like crap, but that's normal. Things rotate back and forth. That doesn't mean I'm saying that's like a perfect rally and everything's great. That means I'm saying that's a rally to be cautious of, but it's still a rally. And where do I want to be? Do I want to be in something that's weak in a rally, or do I want to be in strength? And that's the thing that's always interesting about the relative strength type trading. If you look at the strongest sectors, which are tech, communications, I think discretionary might even be up there.
Hmm.
If you look at the strongest sectors, you really do get to see that those are kind of where you're going to want to be. That's where the safe haven value is, always in the strongest sectors. Yes, I understand, like, people look at the chart and they go, this is low, this is cheap, I want to buy this. And it's like, no, you want to buy the strongest sectors. Those are going to be safe. Money is telling you that it's flowing in there.
Mhm.
And really, like, this is, if you want to say like relative value, like where is this market? It is all in a very consolidated range and just starting to get out of it right now. So it's not something that you would go, I don't want to be in this. It's scary, like it's parabolic or something. No, it's just getting started. You know, if this is a sustainable rally. I just know that most importantly is that, you know, I get, you know, you'll have people go, be careful here, be careful. It's like, don't be careful being bearish in a rally, you know, like be careful being,
Yeah.
what are you doing if you're shorting a rally? Like, are you being careful shorting a rally? Like that doesn't make sense.
Yeah, it's like shorting fresh 52-week highs. I mean, I can't wrap my head around that one.
I mean, and if you historically back test these things, and it's very simple to just kind of look in and back test these types of things, like you will see that that doesn't work. Like, you know, there's an interesting study. If you take a trend following model like 100-day highs, buying 100-day highs and selling 50-day lows, or just closing your position on 50-day lows, and you turn that around and you say, I'm going to buy 100-day lows and I'm going to close my positions when they hit 50-day highs, you will lose money. You will blow up. Like at some point, you will blow up. Maybe risk management can help keep you alive for a little while, but you will blow up at some point.
Mhm.
And people don't really, you know, think about that enough, because really, like, when something is trending, it's trending. Yes, equities, when they're going to the downside, have a tendency of stopping pretty quickly. So it's hard to be a trend follower on the short side in equities. But in commodities, you can be, to the upside on anything, you absolutely can be. Trends are getting started, and they look like they're getting started here. And who knows when they stop.
I like it.
So this chart here, what we're looking at is, you know, we're looking at copper, the S&P. Ian brought up a good point when we first started chatting today, which was that, you know, some of these things that are cyclical based commodities, the ones that you would see going up when the market's going up, aren't really trending with it right now.
Mm-mm.
Um, so what are you seeing here, Ian? So this is a chart of copper, the S&P 500, gold, and treasury bonds.
So we got treasury bonds in purple. Is that the
Yes.
30-year?
Yep, that's the 30-year in purple. And the S&P is in the elder bars. The gold is gold and white is copper.
Copper. So yeah, one thing I've noticed, is especially in with this strength in tech, and communications, and I guess just long duration assets in the stock market, just this divergence between those stocks and those areas of the stock market and other long duration assets like the 30-year T-bond.
Mhm.
Like we're seeing strength. We're seeing those stocks catch a bid. We would expect to see the same from the bond market, and we're just not seeing it yet. That's really what stands out to me. You see, everything's kind of moving up in the same direction, and then yeah, you got bonds catching lower here.
Yeah, I mean, to me, and something that I've always noticed, and something that's kind of interesting, is that bonds have a tendency of really, like, bonds bottoming out takes a while. This is a monthly chart, so really the bottom in bonds was here. This is either November, well, I could just highlight it. This is October 2018. That's when the bottom happened in bonds. And so stock or gold also bottomed at a very similar time. But
Mm-hmm.
gold, you can see gold taking off pretty well, while bonds are kind of just trending in the same area until March 2019. Then they started to catch a move, and they really started to move after that into June. And as you see, gold and bonds also started to really take off. So what we're seeing here is we did get a bottom in October 22. Interesting enough, that's, October 18, October 22. This is where these things kind of have a tendency of happening. The market also bottomed around that point. So you put that all together, and we're looking at this trend. Now, once again, it's moving up. So it's not a situation where I'm going, this bond trade is bad. What I'm seeing is that it's doing what bonds normally do. Bonds also catch a yield. You can just, hold them. They're also kind of making money if you put it in that sense. Like, yes, the S&P does too, but a lot of people hold bonds for the yield as well. So we're kind of looking at this trending in a direction. It's been moving sideways since, when is that? December till now. But I would be ready for bonds to start moving up, especially into the summer. Now, most of the time, bonds really catch a good safe haven bid in May and June. This is because markets get thin, people rotate out of equities and so on, and start to rotate into bonds, usually in the summer. So really, we're kind of seeing this kind of going the general path of a normal cycle. And if we're looking at this and going, is this a cycle ending or starting? It looks like a cycle starting. It looks like that was possibly the bottom in bonds. Now, once again, that could change. That's always subject to change. But looks like there's a bottom in bonds. Bonds are kind of moving up nicely. Gold is leading the way like it normally does. So safe havens are catching a bid. And also, as safe havens catch a bid, tech really catches a bid. So when tech, as you saw, let's, instead of the S&P, let's put tech up here, because tech is a very different animal at the moment. And it's been a different animal. So if we look at tech, that's the elders bars. Pull some of these other ones out of here so we can see it a little clearly. The bonds are making it kind of look funny because it's such a huge drawdown in bonds in comparison. So if we're looking at tech, tech didn't really bottom until November, December, of 22. And if we're looking at, I mixed it up 1 second. And so this is bonds and tech. So tech here, we got that bottom that happened in October, but once again, it didn't go anywhere until January, December, really into this year is when tech started to really move. And so bonds caught a bid, tech finally started to move. That also looks very similar to 2018. Bonds catch a bid, tech finally starts to move. This happens really early in cycles a lot. Like, this is a really normal beginning to a cycle. Once again, bonds catch a bid. This is that sideways congestion in 14. Then tech starts to move. This kind of happens over and over again early in cycles. There's a lot of interesting periods through here that people don't really know about because the markets kept trending up. But there was a European debt crisis. All types of stuff happened through these early 2010s into 2015, 16. Just the market doesn't look like it. We're used to things like COVID, where we're seeing these crashes. But looking at this, we're going, okay, well, early in the cycle, we'd see bonds catch a bid, tech catch a bid, gold start to catch a bid. That's a really normal early cycle environment. And then, like we saw earlier, and you have some charts of this as well that you sent me, copper, one of those.
Yeah, pro-cyclical commodities should catch lower in that environment.
Yeah, so this is base metals and energy. And so these start to catch lower in that type of an environment. And so this chart really beautifully kind of points it out that we're kind of seeing, we saw out of 2020, all that liquidity came into the market. We see a great trend up here, where Russian crisis happened, and that kind of pushed energy a little bit higher right into that end point. And then it started coming down. Everything started to follow with it. We really you'll see commodities usually be the last thing that puts pressure on the market, because as prices get too high, what's the cure for high prices? Or high prices is high prices. So
prices, yeah.
Boom, you're going up. You have these crazy high prices. There's all this pressure on the economy. Finally the equities start going down. That's very normal. And commodities kept going up. Everybody thought that was crazy when it happened, but it's like, look at 2008, look at any of these other periods. That's exactly how it always happens. Too much pressure from the commodities puts too much pressure on the market, puts too much pressure on bonds. Everything starts to crash. And next thing you know, we're kind of into a new cycle. So I really like this chart here that you sent me, because it's really kind of telling of what we're seeing right now. We're not into this new environment where because that's the thing, everybody's looking for the economy and everything to all work as one. And really, markets are not that. Markets are forward looking. So we'll see the NASDAQ sometimes move up. We'll see the next thing kind of move up, and then the next thing move up. It's like that. That's how it works. And right now, it looks perfectly in the environment of tech, gold, bonds. Bonds haven't moved much yet, but I think they will. I could be wrong, of course, but even some of the European currencies, the currencies that are more established, the developed currencies are starting to move. I finally seen the Aussie dollar start to move, which has been interesting too. So, as all of these are kind of happening, and I think we'll end up back in a commodity cycle a little bit sooner than we usually do in this cycle. But for right now, commodities aren't the safe place to bid at the moment.
No, I agree 100%. Definitely from an index level.
Mhm.
We look at the indexes, they look like they want to break down. The Bloomberg Commodity Index it's already resolved lower from a topping formation. Whether or not the CRB index follows, I mean, I'm leaning in that direction. Of course, price has to prove me right. But when I look at the commodity space, those pockets of strength, they're seen over the past 6 months, are just that they're far between.
Yeah.
The only real areas that I like right now are like softs.
Yeah.
I like cocoa. It's trying to hold its breakout. Sugar continues to hold up. Potential bullish flag there forming in July sugar.
Mhm.
Cotton looks like it wants to break out.
Finally, Jesus.
Right? It looks like it wants to go. I really like that cotton chart.
Yeah.
So yeah, we'll see. We'll see. But besides that cattle futures look good. It's precious metals. So a
Mhm.
lot of the base metals, energy, it just they don't look great. Even grains don't look great right now.
Yeah, no, and I don't have any long grains. I don't have any long any of that at the moment. But softs, yeah, like sugar has been trending. It's been on the list for a long time. Cocoa, after 5 billion failed trades, feels like 5 billion failed trades in that market. It's finally starting to move, and that's how it works in trading. If you're a trader and trying to find those big trends, as I do, you're going to have whipsaws, and they're going to be really annoying, and you're going to get a false breakout and a false breakout and a false breakout, especially in a tight liquidity environment. The hard thing is, can you continue to do that without blowing your brains out? Like that's my biggest talent, is I don't blow my brains out, and I can continue to do it, because at some point that cocoa, one trade has paid for all those losers, and then
Right.
and then some, easily. Sugar has been a crazy trend as well. Cotton has been in that kind of flag forever, just sitting there sideways. I watch it all the time, and I'm like, at some point, that is going to be a wild move, and it's going to come at some point, and it looks like it's coming soon. But once again, that's a lot to do with the China trade. That's a lot to do with liquidity. So we'll kind of see where that goes. But yeah, go ahead.
How does the cotton trade, how does that tie into the China trade?
So China is the main buyer of a lot of cotton, because a lot of that is made overseas at the moment. So
Right.
because if they're buying, or if they have, if we see their economic growth growing and so on, most of the time that's tied in and has a good correlation with cotton. And so we'll see both of those kind of come in. Same thing when you can see cotton really move also when China's pumping. So most of the time China is almost like I've never heard this said, and I've never heard anybody from China talk about this, but it almost seems like they always know what they're doing before they do it. So if they're pumping, they almost seem to work into, we're going to be doing this for our economy, and so on. So, or this is going to happen with our currency. Like, they really kind of are planning ahead, whereas I feel like a lot of the other countries are reacting. So when I see that, I go, okay, well, and then that made me start to look into that a bit more and see that cotton is the main mover in that most of the time. Most of our clothes are made over there. Most of everything is made over there now.
Yeah.
So, as crazy as that is. But, copper also being another one in that
Yeah.
trade, that could be an interesting one. So if we get to see both of those kind of come together, now at the moment, China hasn't been doing anything crazy. My dog seems like she's coughing. But you all right? You all right? All right. But most of the time when we see China and that starts to trend, we'll see that copper will start to move. We'll see that all these things will start to move. China's been under a lot of pressure right now still. And I don't even think China is doing that badly. They're big stocks. So they're the opposite of the US at the moment, where their big stocks are doing very badly. They're large caps. And, but the economy is not doing nearly as badly. So it's going to be interesting to see how the liquidity kind of fills into all of these areas. How exactly is this rally going to be this thin rally forever? I don't think so, because it can't last that way. So it's either going to be this thing's going to start to roll over at some point, or we're going to start to see it broaden out. I would more expect it to broaden out, because as time is moving on, I think they're going to start getting more into pumping more liquidity in the market. Somebody will, some country, or we're going to stop raising rates or something. So all these things are kind of coming to fruition. People are looking for rate cuts and all of this stuff. It's like you take it one step at a time. Stopping would be what I would think will come next, and then we can go from there.
Yeah, absolutely. I agree. This was interesting to see, after Powell spoke, or after they hiked rates earlier in the month, the Fed funds futures were pricing in, 8 to 10% chance of a rate cut next month in June.
I did see that.
Yeah. So then a week later, CPI comes out, some more other economic data, comes out, and it's strong. All of a sudden the market flips, and the futures market is now pricing in like a 10 or 15% probability that they're actually going to hike next month. Fast forward to today, and it's almost 40% chance that they might hike. Yeah, it's growing.
Yeah.
So I don't know. I'll check in later today and see where we're at.
Might be at zero by the end of the day.
Yeah,
It's
100% chance of a pause.
it's really how it works, and that's the thing that's the hardest thing, and I think why it's always like futile is predicting what the Fed's going to do. They speak in Fed speak, they speak a different language, they're insane. Like, I don't exactly know the exact answers of it, but it just doesn't seem like you're ever going to be in a point where you're like, I know exactly what the Fed's going to do. It's great. So we got to really, at the moment especially, stick to this price action, stick to what the markets are saying, like stick to strength. Like, we saw a chart of copper just a second ago. Like, you don't want to be in copper at the moment. Okay, great. Move on to the next thing. Do I want to be in small caps? No, I don't. Do I want to be long the dollar? No, I don't. So just figure out where you're going to put your money into. What's the areas you want to be trading? Continue to buy strength, continue to sell weakness, and you'll do much better. So looking at the next chart, speaking of strength and weakness, now this is a close-up of gold. If we look farther out, we can kind of see that this is a massive top here. Let me see if I can pull up a chart of that just so we can check that out. But yeah, gold is quite interesting and always interesting, really. Like, gold is probably the coolest thing in these markets most of the time, because it can always tell me a little bit of what's going on in the market, how it's going to run, where we want to be positioned. And if we look far out on this chart, then we'll go back to your chart. We're seeing that we did run, we had that massive run that starts all the way from, I think, 200 or something, all the way up to 2000. In 2011, we've been kind of stuck around that range ever since. We never have gotten above there, just barely above there. We've closed a little bit higher, but now we've made this triple top. And so pulling back your chart up, which shows that perfectly, now we see this triple chart top forming up here. Do you know the old cliche about triple tops?
I don't think I don't know the triple top.
Well,
Is there
that's
such a
because
thing?
nobody's ever they probably don't even teach it anymore because the thing is there's no such thing as triple
Yeah,
what they say.
right,
So
right.
it's like I could see that, once again, it's things happen, like it's we're looking at charts. We can't exactly I can't exactly tell you perfectly what's going to happen, but most of the time, there's no such thing as a triple top. And most of the time you'll see like you pointed out, that's a resistance zone.
Yeah.
Obviously, it's going to pull back there. Obviously, people are watching it. And if there's enough, fear in the world, if there's enough this or that, whatever it is, and I can't figure out exactly what it's going to be. That's why I'm just being vague. It's going to be something. It's
Mhm.
going to push that up a little bit. And when it starts to peak out over those levels, people will start funneling into that trade like crazy. Um,
Absolutely.
so this chart is like perfectly kind of shows like at the moment, like, for me, that gave that like lack of follow through to the downside, like you're pointing at. That's a great signal. We rip back up to the upside. We start moving to the upside. That starts to get more and more trend signals. Buy. And now we're up to this 2088 zone. It's going to pull back there, but for me, it's still long at the moment. There's nothing that's changed that. But if you are looking for a trade in it and you're just looking at this today, I would be more interested in just buying it when it's over that level of 2088 than
Mhm.
buying it here. Putting a stop at that, that last low over there around 19 or the one around 1800,
Mhm.
or even tighter if you want, whatever you want to do. But I'd really be looking for that breakout at the moment. It's going to happen at some point.
It's gold's back above 1980 right now, barely.
Mhm.
It's trying. Oh, it's trying.
Let's
So
see.
the bulls, excuse me, the bears are, or the bulls are stepping in here, and
Mhm.
they're repairing the damage over the past couple of days, which
Yeah,
is I think is interesting.
yeah, and you'll see that a lot, where nothing trends straight up, and I would have been I honestly, if I'm looking at a breakout, and I've talked about this a million times, I actually grade breakouts a couple different ways. There's a grade A breakout, which is like, let's say like this one on the left side of the screen. We'll go back to my last chart here.
Mhm.
This would be a grade A breakout, meaning it's just run up, it's breaking out to the upside. Most likely those fail. That's not something like it got over these ranges. Those fail most of the time. There's no consolidation before it.
Mhm.
And then a grade B breakout would be something, more like this, the secondary try. We just hit that top. If it does break out there, it's probably not going to continue to run. But the final breakout is a grade C. So seeing that now we've made an oops pattern where we're going to the bottom, we're breaking back up. We've been consolidating since how long have we been consolidating? About 34 months.
Yeah.
Been consolidating for 34 months. That could absolutely break out to the upside pretty easily. So when we look at that further out and like, this type of pattern of quarterly charts, we're seeing that that's a great consolidation. That's probably ready to make a big move. Once again, it was very similar to here. You got a lot of consolidation. We're making a big move, more consolidation, a big move. Now these are quarterly charts, so these look shorter than they really are. And
Mhm.
same with the big last one that happened when we got over those highs in the 80s or the 70s. That was 6 quarters. So right now we're at 11 quarters. That's a lot of consolidation. So I would not be surprised at all if gold starts to make new highs here.
I wouldn't either. There's been, there's a lot of evidence pointing towards that upside resolution. We look at positioning, it looks like, the commercials are starting to unwind. That could definitely drive the next leg higher.
Mm.
And it has all the hallmarks of a healthy accumulation phase.
Yeah.
So I really like gold, but again, like we pointed out, it's messy right now. Near term, there's a lot of risks
Mhm.
to the downside. So wait for that upside resolution. We'll wait for confirmation above 2088. Or if you want to play it tighter, get long above 1980 or 1975 here, like in this chart, and play it really tight.
Yeah, you could you just said, you could get into the playing we hit the downside in the consolidation, and then once we get above this zone, 1980, that's when you might want to buy again. There's a lot of ways to play it at the moment. And silver's another way, platinum's another way. Like all these things look really good and constructive at the moment. So
Yeah.
I'm really interested in the precious metals overall, the rest of the commodity space at the moment. I think that's where money will be made for a little bit, especially given what environment we're kind of looking at here. So here's another chart I noticed that you posted, which is pretty cool. It's precious metals versus commodities. And we're seeing that big base that happened when metals kind of made that top, and then commodities kind of taking over. So we saw that commodities tried to push. We saw a false breakout here. This is a cool chart. So I have not even looked at this, and this is a really interesting chart. What are you seeing here when we look
So
at
we're having there's a bearish to bullish reversal in terms of precious metals relative to the broader commodity space. So this is our precious metals index, equally weight. We keep palladium out, so it's just platinum, silver, and gold versus our equal weight 33 index, with 33 individual commodity contracts that we equal weight. Anyways, we got a reversal here, a bullish reversal on a relative basis that failed. It's so, when I look at this, it's just more evidence that commodities are not where we want to be right now. No, I am bullish. I'm bullish precious metals, but I think commodities in general, like seeing, the lack of healthy rotation between, the pro-cyclical areas, and just the fact that bonds are carving out bases right now. Tech's catching higher. There's intermarket ratios like the copper gold ratio, regional banks relative to REITs are all suggesting lower rates in the coming quarters. So in that environment, leaning on long duration assets, leaning on precious metals, and away from commodities as a whole, definitely your coppers and your crude oil and such.
Yeah, and that all of these do well with, and that's kind of what we're talking about here. The main thing, and you hit a great point there, that we're talking about is things that do well in an environment where rates are falling. That's as simple as you can make this. Like, yes, we could go through and we could talk about all different types of ways to think about this and work this, but really we're looking at areas that do well when rates are falling. Even things like staples are starting to pick up. These things do well in environments like this. Tech obviously is the outperformer, but there's other areas and other sectors that you want to look at. Now, I really like the idea of kind of going, okay, well, where are we gonna end up, and picking, 10 things instead of just picking one thing. Put your I always talk about trading, and I'll always put these videos together, and I'll be like picking like 10 things. And people are like, why don't you just pick one thing? And it's like, well, most of the time I'm gonna get one or two or few of those things wrong. Like bonds haven't been, it hasn't been a losing trade, but it hasn't been a winning trade. It's just gone sideways. Sometimes there's going to be trades that just go sideways. And so what about if I spread my bets a little bit more evenly, and I go, okay, I want to buy this gold, I want to buy this, technology, I want to buy the NDX, I want to get out of the US and buy some of these other countries like the DAX, or buy, Japan, I'm long Japan. Then precious metals, and we're silver, or we're platinum. Now, if we're looking at all of those things and going, okay, well, this is now a trade that has some fire in it. This can move in a major direction, and then also it's hedging my risk. So this is why we always talk about it in terms of what's the macro doing. Well, putting it in caveman terms, falling rate environment. What does well in falling rate environment? These things do well. So what we're looking at here has everything to do with that. When rates are kind of flat to moving up, commodities tend to do well. The economy's doing well. There's a good, people, not even precious metals, but things like copper, oil. These things tend to do very well because people need more oil. They need more copper. Right now, money's tight. The supply is tight, which means that there could be an event like you saw with the banks. The market can just come and hit you in the face at some point pretty easily when money is this tight. Just like the banks, the one bank who failed, the two banks that failed, that can happen easily. So now we're looking at a more thinner rally, these things. So all of these things kind of play into this action and exactly what Ian's talking about here.
You know, it's interesting you're talking about bonds, and I just, how the long duration assets are catching higher. And we have all this, intermarket. Sorry, we have all this intermarket, all these intermarket signals suggesting that rates should roll over. Bonds should finally break out of these month-long consolidation spacing patterns. It reminds me of 2020 when bonds just chopped sideways up there in that top, and like it seemed like the entire market, all the other asset classes, commodities, stocks were moving on, right? And they were 10 miles down the road, and bonds just continued to hang up there, carving out those tops. And then it was finally at the end of 2020 where we really started to see a move, in like January 2021, where they really started to break down. Maybe it's just a similar situation now. It's just the flip side,
Yes, absolutely. So bonds, the one reason when I first started trading, the reason why a lot of people come to me to talk about bonds, and honestly, I'm not like, a fucking genius or anything when it comes to bonds, but I've studied them so much over time that most of the time I get the trends right just because I understand the way they move, not the way they work, the way they move.
Yeah.
And most of the time you see those major topping cycles in bonds. You see those major bottoms in bonds. It's because they usually build up. A lot of people start buying them who are countries before anybody. So, if you have somebody like, they're not going to buy them as they're trending up. They're going to start putting in these lows. And just like oil right now, you're seeing like when it gets under 70, people are buying. It gets under 70, governments are buying. They're not going to sit there and buy it on the way up. That's other participation that'll do that. So you're seeing like at the top, like possibly people selling bonds when it's top, it's hit certain levels. They're like, I'm done with this. I'm done with this. I'm done with this. Same with bottoms. Now they're going, I'm buying this. I'm buying this. I'm buying this. This carves out these big bases. And so the great thing about that is that you can stick about 90 different trend models onto bonds, and it does really well because it bases, they base so much. So it's going to be, to me, I really, and me, I was bearish them all the way into 2020, like been bearish them a long time. I just literally got bullish on them again. I'm not a person who tries to buy bottoms in bonds either. I wait for them to really bottom out because I know how they usually work. And so I think we'll see that kind of pick up here, where they're going to end up. So I wanted to go over a couple things before I got to let you go that I went through on my last video and the blog post. I'll put a link to it in the description if anybody wants to check it out. But blog posts, for me, and speaking of which, me talking about not buying bottoms, this is the first time I've talked about buying bottoms. And we had the last video when it was crashing, and I was like, I will not buy natural gas. I will not buy natural gas. Finally, I'm seeing enough evidence that I'm like, I'm interested, and it finally getting to the point where we are getting reversal signals. So I posted this the other day. We had that massive top. We created that bottom. For me, what I'm also looking at is the farming in the United States and how much output they're going to have to put into natural gas at the moment, and kind of seeing that like there should be a pickup in price at some point coming up soon, especially as we get into growing season. That little head and shoulders bottom. I mean, this is an old chart. I posted this the other day, but I probably may put that chart up, on the weekend before that. We're above there now. Let me find a natural gas price so I can reference that real fast. But yeah,
Got
we're
up
there
to
now. It's
got to 268 today.
268. Okay, so yeah, we're getting up there. That was closed at 224 when I posted that. So we're getting up there. We're starting to move. Most of the time, this period as we get into the beginning of growing season, and a lot of people don't know, like the Midwest, we have our winters last a little bit longer. Like we can have frost all the way into May, so we see a lot of pickup around this time. So looking at this, the end of April into May, like, yeah, we should be moving up. Most of the time it does. That's just the seasonality. Seasonality isn't 100%, but it's telling us that we could move up. Nice move there. Commercial buying. Ooh, that's it's a lot of buying from the commercials, and that puts in bottoms. So when I see extreme buying, like to me, there's people who go, oh, look, there's buying in the commercials. I should be buying natural gas. That's not the way to look at this. The way to look at is it extreme? And when it's extreme, that's the only time you'll see me talk about a bottom. Only time. I really don't. It's not much. It's very rare that I buy a bottom in anything, but this looked great. So we'll see where that ends up. Like once again, it's just started to move. For me, if a trade starts to work and I can get up to kind of break even on the trade, I'm pretty happy. So we're close to break even. If it keeps trending, we'll keep going. We'll hold the long at the moment. So we'll see where it ends up. Wheat was another one. Now I'm not ready to buy wheat, but I'm looking at, and I explained that in the video. But I'm looking at, we came to the pivot. What pivot points are. Basically, they're significant lows. There's basically a indicator for this pivot points. Significant lows within a year are very important points in commodities or equities where you see a lot of reversals happen around that point. There's a pivot here. It's a little hard to see in the video, but there's a pivot point here. There's a pivot point here. There's a pivot point here.
Are these annual pivot points?
Yes, these are yearly.
Very cool.
Pivot point here, pivot point here. The only ones I use are the annual ones, because most of the time there's a lot of noise, but this is sometimes there's big reversals that happen around those periods. And then also once again, is the commercial buying extreme? Yes, it's extreme. So, for me, I'm not really willing to go in and buy wheat right now. But if I'm looking for a buy signal, I'm really looking for a buy signal. If you're looking at for the difference of why I would buy one and not the other, if you're looking at the base of natural gas, there's a base, there's a reversal signal. We're getting up and over moving averages or making a certain amount of day highs, maybe that I'm looking at. But if we're looking at wheat, there's none of that. It's still in a downtrend. So, wait on that one if you are. And then, this is something good we can talk about too. You use this as well. Copper to gold ratio, best thing in the world to kind of understand where rates could go or should be. Yeah, it got a little bit wrong here, but that's it's intermarket relationships. They'll never get everything right.
Yep.
But looking at copper to gold right now, it's also saying rates are going to go lower. So
Absolutely.
I'm thinking,
What's that? What's the middle pane? Is that
so that's a CCI. So
okay? Cool.
I use a 100-period CCI. Basically, when it's under this zone, it's in a bearish zone. So basically what I do is I back test it, figure out like where that zone would be, where I'd be like, okay, I'm looking for signals to buy bonds. So now when we're under here, looking for bonds, looking for signals to short bonds, which would be here. So, as we talked about earlier, that was right at the end of 2020. Now we're shorting bonds. And then once we got here, now we're starting to look for signals to buy. Now, that doesn't mean I'm just going to close out everything. That means that I will be waiting and looking for a signal in the actual price action of bonds. So, like we're all talking about here, this is rates, like rates are so important when we're looking at these markets. TLT You see bonds usually generally jump in the summer months. They're the best months for bonds. 2 years really tends to follow everything else. 5 years kind of getting lower, like the 2 year at some point is going to have to drop and come into normalcy at some point, so I really think, we could talk about this in a second. You could tell me what you think about this. I really think the easy trade right now in the bond market, there is no easy trade. That's stupid that I even said that, but the trade that's kind of hitting me in the face and telling me like, hey, do this is, the 2 year is going to come down pretty hard soon. It's going to come down. Like it's topping. That's a classic top pattern. There's everything that's saying the 2 year could come down at some point soon. Yeah, the Fed like might raise, but look, the Fed was raising and it never made a new high.
Yeah.
That's really telling of the fact that that could just trend down right here and start falling off of a cliff. And either way, I don't see it taking out those old highs. So the trade is pretty asymmetrical.
And that's the juice. You're going to get a much larger move in the 2 year than you will on the 10 or the 30.
Mhm.
When the yield curve ultimately, gets back and it's positive, starts to steepen, it's going to be, based on big moves by the shorter end of the curve.
Yes.
So yeah, I love 2 year treasuries.
Mhm.
I definitely think that's it's not the cleanest chart.
Mhm.
But I do like looking for a buy signal with the shorter end of the curve for sure.
Yeah, I mean, for me, just because of the alpha involved, the 5 year is probably the best place if you're gonna do something on the short term end of the curve. And it's something that's important to talk about, which is like the reason why, like, if you buy like shy, like you're not gonna make money. It's an ETF
Yeah.
on the short end of the curve. But if you buy, it in futures, that's where you're really gonna make your alpha. So looking, one, you got to be a futures trader to really make this trade, but also just understanding what we're looking at is the yield curve steepening out again, and how that can affect the market too is just affecting tech stocks, affecting the bond market in general, all these things. So another trade, a way to look at it, creating like a nice spread trade. You could be short or long the 2 year bond. I'm looking at it because these are yields, so yields are inverse to bond prices. So you could be long the 2 year and short the 30 year, and that's another way to play this, knowing that at some point that's going to have to come into normalcy again.
Hmm.
And so this is just a long-term chart of bonds. We started to hit that, 100-day high zone. I think that's a weekly, so that might be a 20-week high. Not sure. Hard to see on that. Sorry, guys. But anyways, I'm pretty sure I know what my model says, but this just barely hit that point again. That's most of the time that's saying that we're going to move to the upside. Most of the time that's going to tell me when we're going to start shifting and trend. There's no such thing as a perfect model, but this is, like I said earlier, bonds really tend to follow trend models, because of the way they bottom and top. They're really, they make long bottoms and long tops. So boom, we're hitting the upside here. Then we made that big top that Ian talked about. We started hitting that downside here. We slightly had a small whipsaw here for 0.5 seconds, moved right back to the downside. Now we're trying to break to the upside again. If we get over those highs here, like I'd be really, really bullish on bonds. At the moment, I'm like, yeah, I think they should move up, but I'd be very bullish if we start to break over that zone. And now we have the same exact chart. I made
Cool.
the same chart as you
Yeah,
earlier.
yeah. I like that. Throw
Great
under.
lines and such. There's platinum. But yeah, like this is also what Ian was talking about earlier, are there any of these that you like more than any of the other ones still, or like something you would buy today more than anything else out of this is there's gold, silver, cattle, which is feeders, and then live cattle, and then cocoa, and then sugar.
I would, if I'm not, if you're not already long sugar, then I would wait for an upside resolution from this potential, bull flag.
Yeah.
Um, if not, this isn't the time just to jump in and start buying sugar. Cocoa, I like cocoa. You can trade against the breakout level in cocoa.
Yeah.
How you want to define that, 29.50, or if you want to drop it a little lower to 28.50. And then I really like precious metals, like longer term, like looking, further out, over the next 6 months plus. I like precious metals. I like precious metal mining stocks a lot. Um, Live cattle, I mean, they're printing new all-time highs. Is that right? I think live cattle, it's up there. It's
It
up there.
was, yeah, it was for a little while. I'm not sure if it still is, but it was.
So I think that's a good place for live cattle to digest gains, and potentially catch lower and have more of a kind of a digestion, more of a consolidation, kind of like what you're pointing out with gold. How gold, that when you get up right back up to those former all-time highs, that's usually a good place to have that kind of B breakout,
Yes.
right? Or is that A breakout? That A breakout where, now it kind of comes back in, chops sideways, retests, that level of former overhead supply, former resistance, continues to consolidate, and then ultimately resolves higher. So that's what I see when I look at a zoomed out chart of live cattle, like a monthly candlestick chart of cattle.
Yeah, and it always depends, it's hard to futures are tough to say because the continuous contracts can kind of skew things, but it's
Yeah.
sitting against basically its old highs from like, I mean, it's a long time ago. It's like 10 years ago.
Yeah.
So sitting against those old highs, like, yeah, it's been moving in a big way. That's another one that's been a good trade. It's just kind of hanging out. And once again, there's not a ton of alpha in live cattle, so it moves very slowly. But once again, this has been a huge move in live cattle. It's one of those things that if you looked at the grains over the years, you just had to understand that this is going to happen. The reason why is when you're looking at cattle prices, they're affected by food prices. So you got to feed cattle using corn. That most of the time, if the price of corn is moving up, then cattle goes down, and vice versa. These are two inverse products. So as corn has finally come off bid, we're seeing that cattle prices have moved up to the upside. It's really a wild market because there's so many things like hogs and so on like that people don't trade that they really should. There's a lot of good trades in those markets that people don't pay attention to.
Hogs haven't really done much though.
No, they're sitting. It's not saying to buy
Yeah.
it, but there's good trades that come out of the hogs market. There's good trades that come out of the cattle's market.
I think they're coming, man. I think a trade in hogs it's developing.
It does. They don't. It's crazy to see it sit this flat for a while because hogs don't sit flat for long. They're a moving market. You could go. You look at a monthly chart, like they move a ton.
Yeah.
So we'll end on this one. So I don't know if you've ever used this, something that I use, the VIX, VVIX to VIX ratio. When this is in an uptrend, like the blue lines are showing and it's when it hits a new high here. The red lines are when it hits a low. And so basically we're seeing that it kind of gets you out of these massive drawdowns. It kind of says when the market's all clear to move to the upside. We're seeing that it's been on an all clear to the upside since the beginning of this year. This is kind of a good thing, a template to kind of go on for people. For me, it's like I don't want to be bearish at a point when this is telling me that everything's fine, all clear. That doesn't mean that there's not going to be a pullback ever again. That doesn't mean that everything's perfect. It's just saying that things are good. And we'll end on this, and you can kind of explain this to people as well. The importance of semiconductors in the ratio, like, and especially the fact that semis have been on a tear. Like, this is an old chart. Let me Let me pull up a newer one for you, but man, semis have been pretty wild lately. SMH. But yeah, it's like they've been wild lately, and they have just continued to move really nicely. Like, the semis, this is the October bottom right here. Got the big reversal day, and then semis have just gone up and now they're making a new high. I'll give you a weekly chart because that'll show it a little bit better, but we're over those August period, and we consolidated over those August highs, and now we're moving to the upside. What does this tell you about the market at the moment, Ian?
When I look at semis, I think of Dow Transports. I
Mm,
think of like, the old railroad stocks. These are the new railroad stocks for for our generation, or for just the 2000s period. Um, they're so incredibly important. This for me, I look at this like this is risk on.
yeah.
This is, another bullish data point that I think so many investors are either they're refusing to accept or they're just ignoring, because it's not, it's just not confirming their bias. But yeah, I look at this and I mean this is healthy. This is healthy.
I think the same thing, and it's and I'm not, like I don't want to sit up here and sound like I'm on my high horse telling everybody how right I was, it's still been a tough market. Like it's
Oh
a
yeah.
plenty of sideways moves and so on. The problem is that, most of the time I'm not going to get things that wrong if I'm on the right side of a trend.
Right.
Like if whether I'm buying and selling at the wrong times, whether I'm chopped out, whether I'm getting whipsawed, like most of the time, if I'm continuing to be on the right side of a market, I will make money. And that's all I'm pretty much looking for here. Yeah, like there's plenty of people who could say, like, yeah, I was saying the market was going to top here, and I was going to say the market was going to bottom here, but trading it right really means, getting in there and being like, yes, I do think it's going to bottom, but am I going to just buy the bottom because I think so? No, I could have thought it bottomed here, 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 all the way through here. But if I go, this is going to bottom, and maybe my buy signal is, this is a 10-week moving average. Maybe I'm just going to wait till I get open over this 10-week. Now I'm doing things a little bit better. Or, if you're a big trend guy, waiting for it to get over this 40-day moving average. Let's see, when did we get a close over that? Well, we didn't get a close till here. So,
Yeah.
being really safe and waiting for those types of moves, this is what will make you major money in the markets. You're not going to make major money, thinking you're going to catch this. You're never going to catch that. Like I promise. You might do it once in your life or twice in your life and brag about it for the rest of your life, but that's it. You're going to make money by going, I think about an October bottom is possible. And then I'm going to take my buy signals when those come. And if you put that all together, you'll do really well in these markets. But if you're sitting there and thinking like, the world is this way, therefore, like think about COVID. Best example ever of all this stuff, COVID's here, and you get this COVID crash, and semiconductors were the major outperformer in that time. Most of the indexes got below their 200-week moving average. Semiconductors had all the relative strength. They look great relative wise. Yeah, we see it here. Look at the relative strength in semiconductors. It's not even going down against the S&P at all. So you have all the relative strength. You have barely going down. And so nobody wanted to buy it at that time. Nobody thought about it. So you're going, okay, I have the relative strength. And then if you were sitting here and let's say here's your buy signal, and let's say that comes in and you said, well, the world is shut down. The world is shut down. I am not buying a fucking thing because the world is shut down. Well, you lost money there, like, or if you just kept shorting, like you lost money there. So, being open to those things. I'm not saying, no, everybody's done those things, but I'm saying as time moves on, you understand your main goal in trading isn't to catch this or this. your main goal in trading is catching the meat of a move,
Mhm,
and the meat of the move is from here to here. And if you
mhm.
notice that there's no top, there's no bottom, there's no bragging rights, like I don't get to tell my friends about that stuff, but there is, substantial gains, that's 115%, in a very short amount of time for 115% gain. So, even though you might feel like, hey, I missed the trade, I missed this or that or the other thing, you have to know at the end of the day, like you didn't. You're trying to catch the meat of the move. You're not trying to catch every perfect bottom. You're not trying to catch every perfect top. You're trying to survive as a trader.
Absolutely, 100%. And I look at the chart and I see a bearish to bullish reversal confirmed by
Mhm.
fresh 52-week highs.
Yes,
And I think, and those are the kind of charts you want to buy.
absolutely.
And what does that say? What does that say if we're out buying semiconductors? Yeah.
And this is what Ian's talking about here. So as this is hitting, that's a fresh 52-week high. Now there's gonna be just I think I've went over this with you before, Ian. How many friends I had when I didn't buy the market here. Like I didn't buy the market here in this point. I waited till I was above there. I had people like, I can't believe you missed out on the whole bull market. Like you're gonna buy now. It's all the way up here. What are you crazy? Like that doesn't make sense. And it's like, no, there was plenty to go. Like it's not about proving anything. And even if you waited all the way, because once again, this is a spike bottom. These are very hard to trade, very hard to predict, very
Mhm.
hard to do anything with. But even if you waited for that spike bottom and then bought on the next 52-week high, you still made over 100%. Like, so once again, maybe you missed this bottom and maybe it hits here. And honestly, there's another piece of this truth. Maybe it goes to here. Maybe you get
Sure.
stopped out. Maybe you have a stop loss and it goes down and your 52-week high is bullshit, which happens plenty of time.
Yeah, absolutely.
And you get stopped out here. So that's a 10% loss for a potential who knows what type of gain.
Yep. And that's what it's all about. Risk versus reward.
Mhm.
I'm going to find those asymmetrical setups, kind of like you mentioned earlier with the 2-year treasuries. That's what we're looking for. Looking for those setups with high conviction.
Yeah.
Um, and defining our risk. That's what it's all about, just defining risk.
Yeah. Yeah, I love that. And we'll end right there on this chart because it's spot on, like it's spot on because it says everything where, even if the people who are calling for a bear market rally, like they're saying that this is it, it's over anyways, so you might as well be short anyways because this is the end of that. And it's like most of the time that's a beginning, most of the time. And that's all we can do as traders. Like I can't be right 100% of the time, but I can tell you most of the time this is how this happens. And I can also say that our risk is right here. These lows over here that are 10-12% below, like that's our risk. That's it. So as long as we continue with that, that's real trading. What I try to always bring in on here to talk about is real trading. Like we're not trying to talk about predictions. We're not trying to talk about who's going to be the best next year. We're trying to talk about real trading, what could really happen as traders, managing our risk, and going where the probabilities are telling us.
Exactly. You don't have to be right all the time.
Mhm.
You don't have to be right half the time.
Yeah.
As long as you can define your risk and know where you're wrong and
Mhm.
clamp down on losses, the winners will take care of themselves. Those sugar trades, it only take like we were talking the other day. We were pinging each other back and forth. It's like, hey, it only takes 1 or 2 of those to
Yep.
make a year, right?
Think about it just one simple way is looking at this and going, that's 100% trade. This is a 10% loss. That means you could be wrong 10 times and make one of those and it pays for everything, you
Yep.
know? Well, cool, Ian. Well, thanks for coming on, man. It's as always, it's a blast to have you. And this was a lot of fun. I think we really nailed and updated what we've been talking about lately. And I hope you guys can follow Ian at All Star Charts. He's also on Twitter, always posting great content. If you want to follow commodities, futures, everything, he's your guy. So definitely check that out, and we'll talk to you soon.
Yeah, thanks for having me. Let's do it again soon.
Yep, absolutely. Oops, forgot that thing.